Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Today's agenda, we'll go through the market update, the current earnings trades, and then Joe's got some ETF charts. And at the end, Russ sent in some questions about iron butterfly trades, so we'll go through those at the end. Let's see. Hope everyone had a good 4th. We did send out an email. So coming up next Wednesday, we have a Trader Option Summit, and that's our brokerage partner. Ashok will be on a panel. I think it's 1:35, right, Joe? Is that right?
That is right, Josh.
Yeah, and he'll be talking about AI. So I know people had questions about that type of stuff. So we'll try and end ours. Because that's right on Wednesday, in time for people to jump onto that. So, okay. Any other comments on that, Joe?
No, I think, Ashok will be one of, I think it's 4 panelists, and they're going to talk just about the impact of AI, in the trading space. So I think the whole event runs maybe for 4 hours, starts at 11 Eastern time. So and actually we sent an email out today, which everybody should have gotten. So if they haven't registered, maybe they could, or if they have the time to do it. So
should be interesting panel. Okay. So we have that. Just want to highlight that, like Joe said, you should get an email with that from us. And we'll just remind, and we'll try and close up shop early next week so we can all tune into that. Okay, overall market. So big change here. Russell went into state 1, and you can see right here, right above, it won't let me highlight, right above 1900. So we've been talking that big level. So right now it's above that, and I think higher today. So we'll get into all the indices here. Overall pie pretty much even from last week, and we didn't meet last week, but even from there, from like 2 weeks ago, pretty much right around even from where we were. A little strange, kind of how it's behaved here, but pretty much flat. We thought possibly for a crossover, but it just hasn't happened. Just pretty much going sideways here. Although the SPX obviously has gone up and the indices have gone up, but market pulse is pretty much flat for those 2 weeks. A little strange, I would say. I mean, if you pull it out, it looks kind of weird. We don't see these kind of shapes normally, like these circles, half circles and stuff like that, especially like here, and then you get one right back to back. Just a little strange, I would say. But overall markets, gone up, since our last meeting 2 weeks ago, 43, about 6 points, and up again today. So
Hey, Josh.
Yeah,
it's Lee. I don't want to interrupt, but on this topic, you're talking about this half circles. Is there anything in the news that you're aware of that would cause that? A lot of times the stuff reacts to news.
Right.
I was just wondering if you or anybody had an idea of what caused or what happened at the same time.
Well, the inflation print was mildly lower. That was today. So maybe, a little foreknowledge of that made things kind of turn around here. But I mean, rates have went way up, well above 4 during this kind of time period. So, it's just, I'm not certain of any news driver that reflects this kind of activity. Joe, did you have anything?
Yeah, no, I just think, the market's awash with liquidity, and more and more seems to be finding, the market, soft landing, all that jazz.
Right.
Nothing new, really.
Yeah, it's nothing kind of strange if you ask me, but the whole we are in earnings.
All right, well, thank you.
Yeah, so this is,
I say, Josh,
yeah,
I just wanted to comment back to Lee there. Personally, I think that the markets are just getting more, say, believing that we can have higher prices and higher inflation at the same time. That's kind of what I'm thinking. Now, businesses are raising their prices and they're being rewarded for having pricing power, but they're still raising prices. So I think that's what the market participants are all believing, that the Fed is going to lose out on its 2% driving goal here for the time period that the Fed had in mind. So we'll have to see how that plays out in time. That's all.
Yeah, I definitely agree with that, Dave. I mean, I think the prices. I saw a headline here that egg prices plunge while other stuff stays high. That's kind of what I talked about. I'm like, oh yeah, I really watch the egg prices. And this is the headline, 2 weeks later after I talked about it. But all those other, the consumers are hurting. I'll pull up and I don't know how long that takes to trickle through. But this is the car loans, so this was like the last month change. So, this is, you don't see a lot of red here. People getting car loans, non-revolving credit monthly. This pretty much what they said is these are like car loans. So, you saw one here in the pandemic when everything shut down, but, we've just gone red here. So I think the consumer is hurting from these higher prices. How long it takes for that to filter through, not sure. Here's another thing that's hurting, me and you, the average Joe's credit card interest rates. Obviously I would recommend you pay off your credit card every month. But there are people that carry balances, and you can see this has gone up. It's all the way up to 22, like all-time highs. This is from, since 1994. This is the average credit card interest rates. So, it's at all-time high. I mean, this is a huge spike. If people aren't, those people that pay the monthly minimum or something, they're getting charged more and more. So, it's, I don't know, they're charging higher, but I mean, at some point, I know there's a lot of hurt going on with the inflation with kind of average people, not so much, government spending and things like that.
I read a piece from I don't know where it was, but Bill Gross was the the guy that they were talking about. He's like the bond king, and he said it's the YOLO, you only live once people that are funding the growth over the last couple of quarters. But he says sooner or later they're going to run out of money. He says, so they didn't know when that would be, but sooner or later.
Yeah, I mean, at some point, you get overwhelmed, but I don't know, maybe we're not at that point yet. And we do have the interest, the student loan. We do have the student loan payments coming back, and I think someone said that was like September.
It is. Yep.
Yeah. So add that on to already struggling people. But I mean, that's, we're just seeing little signs here, but you can see back here, I mean, we don't get these red marks for, auto loan change, monthly changes much. So I'm not sure the prices of, used used cars or new cars, but haven't been shopping recently. So, yeah, just another data point. But we know a lot of regular consumers are hurting just because of stuff like this. Food prices, oil, gas prices. They're not cheap. I mean, it's not the highest we've seen, but just like another weird story. Like after the 4th, I drive home and I got gas for 309. The next day, everywhere it's 349. And I'm just like, what? Like every single gas station around me is 349 when the day before it's 309. Just kind of strange. Not like, I don't know. Not saying one thing or the other, just strange occurrence that it would jump that much in a day everywhere. So, okay, let's get back here. So, we'll just have to see if this holds. If we get another upswing, obviously we can get another upswing higher. It's happened before. And just like shape wise, these little half circles are just kind of strange. But it's trying to go back and look for stuff like that. I didn't really see much like those kind of half circle type things. Once in a while you'll see something like this, but not like back to back too much. So I couldn't really find anything that kind of matched that shape. But I think the key thing is obviously we're not overbought or oversold. As far as the pie, we're getting closer on state one. It's 45%. That's overbought. So it's creeping up a little higher, but definitely not oversold. So we're still kind of in that middle ground. And I just want to see if it breaks one way or another. Just kind of been chopping, but the market, as you can see up here, has been grinding higher, even though we're pretty much sideways on the pulse. So one thing I did want to highlight, we are seeing a little more breadth. So you can see here, we get some more 5. So we have been climbing there. I'll pull it up on this chart. It's been slow, but we are starting to get a little more breadth. Just like slow grinds higher, right? So this what we talk about a lot is for good bullish runs, we want to see them to go to 8, 7, 5, and then 1. So we've had a good decent pickup in the ones recently. That's kind of near the high 32 recently. So we got 32 again here, and now we're back at 32. But the 5s have been kind of slowly grinding. So I'd like to see those 8s go to 7, and then 7 to 5, and obviously the 1s. So, as far as highs and lows, so this is definitely a more bullish sign. We're getting, this is basically, let's go back to here. So this is a bear market, right? So we're starting to see, see little signs of life here, seeing more signs of life here, right? So not calling it a bullish market yet. I think if we can hold above that 19 and not, for the Russell, not drop back down like we did the last 2 times, then we could, see bullish. But this is encouraging, along with Russell going into 1. So everything's aligned now, in the most bullish states. Obviously, when things are in the most bullish states, that's when good things really can happen. So everything's aligned. We're seeing positive signs, right? Overall, this is the 200-day. That one's crossed over. So we just want to see a continuance of that type of stuff. So, our last meeting we talked, this target 3 holding for support. So that did hold, it's basically highlighted that as a key kind of downside. If that can hold, obviously we can get a good run off it. So, tested basically like, a couple days here, that 43.40 level. So 1, 2, 3 days, and then just took off. So obviously, we're kind of off the map here a little bit, but we have our Russell, because we're pretty much middle of the range. We're 42 to 46, so we're right in the middle of the range for SPX. And the only thing we really have right now is this target 3, 43.40 support. And then also we got our moving average, but that's below that 43.40, so it's 42.90, call it. But like we've been saying, we've been watching this 50-day here, providing good support. That's a good sign of a bullish market. So it's been telling us, just, are we listening? So, eventually, we're pretty far off that 50. At some point we'll come down and test it again. So, that could be a good entry point, if it's a bullish market overall. So, but right now, middle of the range, really the only thing we have to the downside is that target 3 again, 43.40. We're over 100 points above that right now. And then, to the upside is 4,600. What we'll pull out is kind of the last time we were up in this area, the high here, this is March of 2022. We got up to, let's see, 46.40 kind of range. So that 4,600 is going to be, the current ceiling right now, but we haven't been there in quite a while. So we'll have to see. But what's 50-day and the target 3, I think it's kind of where we're at with SPX. Russell, more importantly, Russell, so we're above 19. We're actually a little higher today to 1937. So, we did break out of these before, and I'll just kind of highlight that. So we still want to be a little careful, but, if we keep holding this 19, that's obviously a good sign. But, back here, August, we popped above 19, got up to, 20, 30. Here was a lower high, we got up to right around 2000. So we've had breaks above that 19 before. They had sharp rallies and then, petered out fairly quickly after. So that's the only thing we really want to guard against, but we can start, I think, feeling a little more bullish. When we got above these, we weren't in state 1. So here, it was 7, 5, turned around. Here we got 5, we got a bad 1 here, obviously, but we're breaking right, the 1900 while going into state 1. So, it could be, this could be, the start of a bullish move. This is the only thing we really want to guard against. We get this pop and then it, then it dies on the vine. So, 2000 kind of range, is where it failed before, twice. And obviously came back, was really strong down to the downside. So, but until we see anything, our typical pattern here, we kind of climb up here, retest, get up here. And then, it's kind of like 20, 30%, it goes higher, and the rest comes back down to 2. On average, it'll get 6% or so. So it's in between these. So it'd be right at that 2000 kind of level. Is typically where it will fail, like 20, 30 kind of range, which we already highlighted on the chart. So obviously, I think we want to watch this entry point, 1914, and then right below that is 1900. And, your next level of resistance is in the kind of 2000 range, 1990 to 2000, that kind of range. So downside, we have support at 1914, and then 1900's the big one. And then to the upside here, 2000, I mean, so that's where
Hey,
we're
Josh,
at. Yep.
while you have that up, just back to the Fibonacci numbers.
Mhm.
From the November 21 highs, down to the October lows of last year, Fib numbers are basically 1950,
Mhm.
2050, 2050 would be 50%, basically target 3. And then all the way up to 2150 would be a 5/8 retracement. So
Okay.
we've already, we've done a little bit of that, retracement earlier, as you pointed out, those 2 previous highs, but 1950, 2050, and 2150, and kind of interesting how target 3 matches a 50% retracement of that whole, downside move.
Yeah. Yeah, very interesting, right? That shook's on to something.
And also drawing trend lines across those couple tops, might be a little bit formidable too. The August top and then the February top, kind of a downward line, a little bit down.
Talking like this.
No, I was actually talking the previous high, August of 22.
Yeah, whoops. Oh,
From that high, that one, bingo, right there.
yeah.
So,
That'd be-
and that's probably just a little bit north of 1950.
Yeah. Yeah, that's probably right. Well, it might be a little higher than that, but in the kind of same range as this target 1 area, maybe a little below it, but probably lines up pretty well with it. At least right now, as we get into it, it'll keep coming down. So
Nothing crystal clear in terms of coming out of a bottom with a wave count to the upside, so we just see what happens.
yeah.
Interesting to get that into a state 1 today. And as we all know, NASDAQ and SPX, they're really long in the tooth with their state 1. So it'll be interesting to see who wins.
Yeah. Well, they're good. I mean, the support at target 3 for SPX was, critical, obviously. These, I can't overstate, the importance of these kind of levels for target 3s and stuff, especially state 1. So I think this was the key right here when we talked about it. If this provides support, then we can see it go. And this is followed through. So, I mean, look at this chart down here. Look at this thing. Like, it doesn't know what the hell to do. Up, all the way down, all the way back up, and breaking. So obviously something happened. I think in here, I'm not sure. Nothing I read about, but something really caused this liftoff, right? So, okay, that's just okay, bringing up the previous breakouts here above 19. So we got our first one, second one, maybe third time's charm for the actual breakout. So, just keep your eyes on those kind of levels, and, cautiously optimistic about, this is another kind of level we can watch at 50 days, provide a good, since we kind of highlighted back here, it's been a good rider, showing bullishness for the market overall. We didn't see a lot of breadth. So, let's keep our eye on the breadth, which really means Russell. So, if we keep getting breadth, obviously that's a good thing. But, we are in earnings season, so we'll have to see how, those things start coming out, how the market reacts to it. But, we typically see pretty decent runs during earnings, and, that's reflected so far. The trades have done well so far, and I'll go into those in a minute. Okay. Fed tool. So this is for July. Still got 92% for a hike. So we got some time. I think 2 weeks, till this meeting. So they're still pricing it in. Markets changed a lot over the past few months that we've talked. Still no back here, I mean, they had like 3 cuts from like 5 a few months ago. Now pretty much no cuts for the whole year. So that's all priced in the market now, and see how the Fed goes through that. Balance sheet, we have dropped below our Silicon Valley Bank issue level. That was 88,340. So we're down to 88,300, 8,300 billion level. So they continue the balance sheet runoff. They continued it, despite this big hiccup. So let's see if there's any more banking issues. Last time we ran in, I talk about this occasionally. From the previous time we had an issue, it was like a 15% drop. So that would be right around the 77,500,000, billion. Sorry, these numbers are astronomical. Level. This would be, kind of the same level as the previous crisis, where they pivoted. So still a long way to go down to that kind of level. We had a couple numbers come out just real quick. Inflation, that's what we were talking about. So cores 4.8, so below kind of the consensus, and same with like an inflation rate overall. CPI is a little lower than consensus. I did want to kind of pull up these charts. So this is the core inflation. That's what the Fed really goes off of. It's kind of mirroring, like we've shown a lot of these like M2 charts and stuff where they kind of come up and then come back down. So that's kind of what I would expect of this core inflation. Now, the CPI, this is like, our dollars is being crushed on an annual basis. So, since pretty much the gold standard. So this is pretty much a trend line up here. You can see it never drops below that trend line. So if we do run into trouble, I would expect it just to, come back down to this area. If we run into trouble, in future quarters, doesn't look like we're in any trouble currently. But there's, as I keep showing, things that have, take a while to cascade through the economy. Consumer issues, things like that, the commercial banking, all those things. We'll have to see if that, at what point things can turn around, but it's looking good right now, but way off the trend line. And it usually, I think they like to keep it nice and on that trend line. So at some point, either we'll like flatten out and come up over to that trend line, I would think, or, this is like 2008, it's like a mega crisis, but CPI pretty much wasn't, it's just, pop up and then come right back down. So I think this is key thing to watch, along with that M2 and stuff like that. So, but I know I've shown this before, but it's pretty interesting to think about, your purchasing power eroding over time. I mean, it's just constant. So, okay. Charts, I showed you guys this, the non-revolving. I did. Here's the small bank balance sheets. So the small banks, like what their balance sheets are composed of. So if we do run into another, because I pulled this up, I was watching, the 10-year. We got up to like 405 or something. So we've had a pretty good drop off here past day or two, but the credit card rates are still well elevated. But this is, I think, where things can, cascade for these smaller banks. If those rates, really, it's the rates you got to watch. That's where these banks will get in trouble, just because of their balance sheet and what's in them. I think, I don't know if I pulled up these. Yeah, I think that was it. Yeah, I think that's it. Open up to questions, comments on the market overall.
This is Dave, and I'd like to give again credit back to Sadir a couple of weeks ago. He said, it looks like the market could just melt up for a while, and that's certainly looks like what it's doing. So,
yeah, I mean, yeah, I agree. Just melting, but not a. I mean, that's obviously a good sign that inflation's, but it's still elevated, obviously, and yeah, it's definitely a good call. Anyone else? Okay. Earnings trades. This started. We got about a month ago. We put it out. So bullish pre-runners, so far we've had 7, 5 have closed out, hitting their profit target. So we got 2 open, CVX, Travelers. I think there was one this morning too. These are only the confirmed ones, obviously. Yeah, BX, bullish pre-runner, came out this morning too. So it's off to a good start. I think we've had 2 bad quarter ones in a row, but all the other ones have been good for the most part. So these 2 were open. This one's pretty close to hitting. That's at 17%. Just looking for 25. Travelers, we still have until the 19th, so about a week or so left for that one. That's a regular, I think, at the beginning of these. Here's all the ones that did close out. Capital One, Wells Fargo, Hilton, J.R. Horton, Prudential all hit their targets relatively short times, 4, 3, 4, a couple days, 4, about a week. So overall good. Bullish pre-runners. There was, I think there was a bearish, well-timed bearish trade as Wayfair. That was a pretty much one-day trade, closed out. And we have one, the only other one so far is this bullish runner, this Nike. That came out on the 3rd. So that one's down right now. I didn't see what it's doing today, but these have worked out so far. So up a little. So still got a little time on that one, but overall, positive start for earnings. What to see once these actual earnings reports start pouring out. Wells Fargo 13th, so things should be kicking off in the next day or so with these bank earnings. So any questions, comments on that?
Dave, again, I have one other comment. I'm not sure that it can't tell you exactly what it's focused on, but I was talking to Joe yesterday. And by the way, thanks, Joe, for the heads up and email that you sent me. That was helpful. With regard to a change in ETFs and how they're going to you know, a potential, not a potential, but a change that's going to happen on the 24th, where this is NASDAQ and ETFs that are in the NASDAQ. And why they're making this change, I'll tell everybody why they're making this change, is that the rule changes, instead of a 1-for-1, you know, when you buy an ETF that's got Apple or Google or Amazon or, you know, some of the high, say percentage-wise owners or gainers in the index are the ones that have the most influence on the index, which are all the really high market caps. Well, they're not going to be buying as many shares just because they're in the index as they have in the past, just because they're in the index. Now they're going to be, and you know, they haven't released any of the calculations or how they're going to implement this, but they're going to buy less of the higher percentage occupants, if you will, than they have in the past. And the reason for doing this is that they want to create wider breadth within the NASDAQ. I think they were saying that the seven stocks in the NASDAQ were responsible for 51% of the growth in all of those indices and ETFs. So, and a lot of that was based upon the AI hype that was going on a couple of weeks ago, or maybe a month ago by now. So I think the idea is we don't want the biggest cap stocks just to get a bigger cap just because they have a bigger cap. So we're trying to do something to. I liken it like the Fed is gradually or slowly raising interest rates to, you know, hamper inflation. Well, I think this is the same idea for the people that own the ETFs. This is not coming from the SEC. This is coming from the ETF owners that, well, we don't want to see a big drop off in you know, the entire ETF if these 7 stocks end up having a problem in the future because they were all hyped up yesterday.
Well, so they should, yeah. What they normally do is they rebalance. So like if things get out of whack, you know, it's cap weighted, you know, and Apple's like torn off, you know, gone off from like 8% of the fund to like 14, like they'll rebalance it, you know, so they'll move it back to 8 or, you know, whatever they randomly come up with for, you know, the weightings. So that's what I think they normally do.
I've got a question on this. Are they going to equal weighting for each of the stocks? Or is it something different than equal weighting?
I don't think it's said yet. I have been looking for that kind of like detail myself, Lee, and I haven't really found it yet. Now, they announced, and they announced why they're doing it. They announced which stocks are going to be most affected, and why. And it's, you know, by the way, it's going to happen on the 24th before the market opens. That's a Monday. So, you know, it'll be harder to trade option strategies against that when there's 5 more days in that week before the Friday options expire. So you'd have to make an options play before that with a diagonal or a calendar trade, which are some of the trades. I've actually played this idea 2 or 3 times with a modest bet, if you will, just to see. But it's happening at the same time. The 24th is the Monday. FOMC decision is that Wednesday. Apple, I think, and Microsoft are due to announce their earnings in that same week. So there's a number of things that are all going to kind of like muddy the water. I don't know how the people that have designed the requested change or their change is going to have a ability to see, well, our change had this much a positive effect on what we're trying to do, just because of all the other things that are going on in that same week. But it might be a total wash. I'm just saying it's on the 24th, so you know, one of the higher percentage-wise stocks, it's liable to be sold off automatically a little bit on the 24th when the market opens. And people use that to buy the dip. Who knows? I don't know. We'll see. But I just thought
definitely interesting, Dave. You know, especially of all those like confluence of events in the same week. So interesting. We'll have to look more into that. All right, thanks, Dave. Okay, we'll let Joe get going here. Ready, Joe?
All right, Josh, just a couple charts, and then I know, like you said, Russ said send over some questions so we can get to that. Just let's see, a couple charts. You know, it's been a couple weeks from an ETF perspective. You know, the overall bull-bear ratio hasn't changed. 8 bullish, 3 bearish. Just one, you know, we went from 4 state ones to 5. We added materials, which is this the XLB almost 2 weeks ago. You can see from a chart perspective, you know, nothing too exciting there yet. Whether it turns out to be a good state one, time will tell. Whether we get some leadership there, if the market takes off, could be a possibility. But that's the one that rolled into state one from 2 weeks ago. The other 4 remain the same: technology, consumer discretionary, industrials, and communications. Let's see. Yeah, and the XLK, I just pulled that up basically because, you know, we're getting into earnings seasons. Obviously, this thing's had a monster run. What a state one, you know, going back to end of February. And, you know, can we sustain? We are at 90 days where the average is 40. You know, whether we do a pullback to state 2 and then run again remains to be seen. But got to believe, and earnings in this sector, I guess, are a little ways off, but got to believe it's going to be earnings that is going to define whether, you know, we get an even longer state one. And, you know, this has been leadership from the get-go. I think, let's see. Oh, and energy is one that kind of rolled the other way. It had been in 8, you know, a few weeks ago, which I think I mentioned at the time, and, you know, just turned around. So not that we're going to get leadership out of energy, but at least it may not be, you know, a downward moving index at this point. So, you know, from an ETF perspective, that's it. If the platform were quicker, Josh, I'd hit some more charts, but I think that'll be it for now. We can start to talk about Russ's questions, and then I'll get into Delta a little bit with some charts on that. So I'll turn it back to you.
Okay. Okay. All right. Okay. So Russ sent an email just asking about the iron butterflies. So what I'll do, I'll just kind of walk through how these are selected, so people know how to, you know, basically, you know, create these trades. Now they come out on the alerts, you know, like 3 something before the close, so it'll give you time. But, you know, as you go into the day, you know, end of the day, you can kind of, you know, if you're planning on doing these trades, then, you know, you can, you know, monitor them over time. So basically, you know, based off of this right here, this is Delta. So the close here was 80, 48.66. So, you know, we're going slightly above that for our sell strikes, right? So, you know, and this is, you know, if you want to change it yourself, you can obviously do that. So like now it'll, like the actual trade will update based off of, you know, the price after 3. So this one's 48.29. So this one, instead of selecting that 49, which is right above the 48.66, it would select this 48.5, you know, based off of this price, you know, the current market price. So, so if we did the live one, it'd be here. So we're selling our 48.5 put for $1.19, and then selling a call for, you know, $1.34. So we're selling each one of those, right? And then for protection, we're basically taking this range, this expected move. So that's 230. So, so, you know, below that 230. So just call it $2. So this 48.5. Sorry, the screen's in the way. So that would be a problem because, you know, we're basically, we don't have the 0.5. So maybe you would want to go with the 49 or the 48, you know, because if you go up 2, you don't have a 51.5. You know, down below you do have it, but you'd want a balanced one, you know, unless you have a preference on which way earnings are going. So, so we'll call this 48. So we're selling 96, selling to 161, and then basically $2. We're buying this call at 50, and then buying this put at, you know, 37 cents. So you have 96 selling, buying, and I can get out the calculator and you can, all right. So 0.96 minus 0.37, so 59, and it's too wide, right? 1, 2. So so basically 1.5, 1.4 is, you know, the total amount, and you're getting just called 60 cents. So you're risking $1.40 on this side. And on the other side, you have 161, and then you go here, 0.73. So 1.61 minus 0.73. So we add that to the other side because we're only risking 2 on each side, right? So we're basically getting $1.48 for a risk of $2. Does that make sense? Trying to do the quick math here. So we're 2 on each side. We're risking $2 on each side. So, you know, you can only lose one way. So your max risk, you know, the max you can risk would be $2 loss. But we're getting 88 cents on this side, at least on this print right here. 88 cents on the call side and 60 cents on the put side. So we add those together, 148. You know, we can subtract 2. So that's our risk. So our max profit is 148, and then our max risk is 52. So that's for these prices yesterday using that 48. You can do the 49, same kind of deal. Yeah, depending on preference. So, but you know, this one right now is 48.24. So I would just call it 48 if I was going to do this manually. And that's the risk reward amount. And that's kind of what we like to see, you know, 2 to 1, 3 to 1. So that one ended up being about almost 3 to 1. Risk times 3 is about, you know, it's about 3 times your max profit. Does that make sense? Someone give me a yeah.
Yes.
Okay. Okay, so that's how you do it. And then, you know, you can pull up the live chains. Obviously, it's a moving target, but, you know, unless it's really moving. And so what we select is, you know, some people, like if you do this week's expiration, it's obviously going to be more risk. So what we do the trade for these trades is another week out. So this is the weekly. The monthly is you know, the following week. So that'd be 2 weeks away, which is what we want, right, for this one. Normally, yeah, we don't normally we just trade the ones with weeklies, but you know, we updated that trade list. So now like this one fast comes through. It worked out, so the monthly is 2 weeks away. But you know, if it doesn't work out, then you can, you know, if this was the next available, then you may want to pass on that trade because it's not 2 weeks away. But we haven't, you know, we just wanted to consolidate that one list of liquid options to one list and not, you know, they don't all have weeklies, you know, even though they're still pretty liquid overall. So it'd just be the same exercise with fast. So this one, we'll just call it 59. So these trade, these ones are a little awkward, you know, like, I don't know if I would actually trade this one, you know, unless it's near the number, but basically we would go and use the 60, like implied move of buck, you know, buck 69, buck 70. So I don't, you know, maybe this isn't a good candidate, because basically you're going to have to do 60, sell this and this, you buy this and buy that. So I can do the risk numbers here. That'll be a buck 20 and 0.8. So it's a little outside our expected move, which is 1.6. Normally we like to be inside it, but you know, it still works. Because this is 250 away, this is 250 away, you know, so it's outside our expected move. Just that typically means you're going to get less reward. So 1.2. Oops, sorry. Let me do this real quick. 0.8. Let's just call it 0.2. So 0.6 plus 1.2, 1.4. Yeah. So this is your max win, 1.4, and you know the risk is 2.5 wide. So your max risk is 1.1. So it's not, you know, so obviously it's outside expected move. So you're going to have 1.1 for risk and 1.4 for reward. So it's not quite 2 to 1. You know, not really close to 2 to 1. But you know, that's the trade that came out for this one. Not an ideal candidate, but you know, if it doesn't move, then it doesn't move. So it's a little more.
Josh, in regards to the expected move, since it's an earning week, does that fluctuate more so? And can you compare that to your earnings analysis sheet to see what the average is?
Yeah, you can look at the averages, obviously. You know, this expected move, we just base off of whatever the expiration is. So every expiration is going to have a different expected move, right? So this one's 3.5, and that's how much you expected to move from now to 8/18, right? So this changes based off of how long you're doing it. So, you know, this week is 1.91. You know, the following week is, you know, it's gone up about 30 cents or so. So that's how that works. You can pull up the earnings analysis. So that front graphic, it'll show you the expected moves. You know, percentages based off of, you know, like how things were. And this is the price one down here. So you can see, you know, price moves here, $2, $2.44, 193. And then, so that's the expectation. And then here's the actual moves here. This is for Delta, obviously. So fairly small price moves, right? With the expected moves, does a good job staying inside the bands. Does that make sense?
Can you explain that again? Let's see how much the move is again, average?
Well, on it, it'll change every time, right? So every
Right.
time it's different. So this one was 4, this $2 something. So that's the line. The lines are the expected moves up and down. They're the same to the up and the bottom. So Q1 was $1.93 for the expected move. This is the actual move. So it dropped.
Oh, okay, that's the actual. All
Yeah.
right.
So the actuals here, and then this is the bands are. So we like to see, you know, for these iron butterfly candidates, we like to see them stay inside the bands, right? That means they're staying inside the expected moves. And this is just, 1 day. So this is like the 1 day move. So, if you get a good return after 1 day, obviously get out. If it moves against you like this, where it's, the expected move was $1 something and it moved, to something, that's why we have another, week and change for it to come back. That cleared up, Russ?
Yes. What about the other charts that are on that screen?
These are just earnings surprises, and we know the earnings are, obviously important. Guidance is more important, for future stock moves. So this is just, the overall frequency, the drop. This is the same thing, just on a percentage basis, for the stock. I prefer to look at this one. If you're analyzing the iron butterfly, this gives me a nice look at, okay, is it in the bands? Because this will be relative to the price at that point. So, it could have been $18 or something at that point, and it made a big move, but it was only $2, $2 move. But at that time, that was 6%. So, this is kind of like the granular, you can look at the last few, and I just see here, generally it's staying inside the bands, and then, kind of look at the last few to see what the actual moves were. It's like $1, right? $1 or less, last 4. This is just overall, whether it's been positive or negative results. So green is an up move, red down. That's kind of how I'd run through the analysis. I mean, this looks like a good candidate, right?
Hey, Josh.
Yep.
This is Dave. One thing that I think is probably important to consider or take into consideration is what day of the week the earnings comes out, and compared to what day of the week you get into the trade. If it's a earnings report is out Friday or out Thursday, and you only have Friday, that's why going to the next week is sort of important.
Oh,
So
yeah, definitely.
at least a week to deal with,
Unless you want to gamble.
Yeah, exactly. So by the way, that's one thing I do is if it's a Thursday expiration, I always go to the next week. But if it's like a Tuesday expiration, sometimes I'll do that same week, because you get the move on a iron butterfly. Most of the movement or the benefit of the trade comes in at the very end of the trade. So
Right.
make sure you have your exit strategy out ahead of time. And like whether, I think it's what you're on 25 or 50% on the iron butterflies, 25, right?
Yeah, max profit 25, kind of 20. I mean, if you're staring at, like 18% on day one, I would just pull it, right?
Right. Right, exactly.
But kind of like 20 to 25.
So yeah, so especially again, take into consideration other things that are going on, like the FOMC meeting, for example, is just when a lot of the big megatech stocks are going to announce during that very same time period. Yeah. So I think that's almost the thing that I look at first, is at which day of the week expiration are we, earnings report coming out. What was that, early in the week or late in the week? It has a definite impact on my strike selection, as well as whether I do 1 or 2 weeks. Sometimes I do 1 week quite a bit, just because I think I'll get the move or I won't get the move, and now it'll be a big enough move in like 1 or 2 days, rather than having to hold over a weekend for the second week to expiration to wait for your 25%, whatever your target is, to get there.
Yeah. Well, that second week is for those ones that
don't make it, quite make it.
Yeah, that they move outside the bands, and they just have a kind of tendency to come back in the range that second week. Not all the time, but I would say enough that we changed it. So little little less, it's just risk reward, right? So if you're on the front week, your reward it's going to be higher if you're right, but if you're on the back end week, your reward may be a little lower, unless it like comes back on the last day, that the following week. But your risk is generally lower if you're on that week out. Thanks, Dave. Okay, I think that was it for this. Joe, did you want to talk about?
Yeah, Josh, I know that Russ had asked about a double calendar. So here and basically a double calendar is just like any calendar, except you're doing both the call side and the put side. So you're buying time, selling front month. You're just doing it on both sides. And that's why they call it a double calendar. Let me grab the screen. I pulled up a couple different, here we go. Let's see. Okay. So, and I know we're running late, but I'll just go through this. Let's see. I wanted to start here. And when you talk calendar spreads, the key, at expiration is where's the stock going to be? And so that strike selection is critical. This is a horizontal trade as opposed to what Josh was going through, more of a vertical trade, with your strike selections. So that strike is critical. When I hit this up, just before we jumped on the call, I was a little bit taken back. I mean, I don't really know Delta too much as a stock, but, and I thought for the most part it was a fairly low volatility stock. But then I looked at it, I'm like, wow, stock had a pretty good run, in the last, month and a half or so. It's gotten through an awful lot of different strikes. So am I confident that, after earnings, the stock's going to hang out at this 48 strike? Me personally, no way in heck. They're looking for 242 on the earnings. It'll be interesting to see. We can talk about how this reacts, in the next week's meeting. But the fact that we've moved through so many different strikes leading into earnings, for me personally, gives me, no real confidence picking a strike. My best guess would be is, the stock may come, unless they just blow out earnings. And it looks like the last couple quarters, they did not. I'm guessing, you maybe get a pullback, and I'd be probably more inclined to do something in the 45, 46 strike range. But I did price out the 48s because that's where the stock was. But before I do any of these volatility trades, I'm going to the vol chart first and foremost. And here is the Delta, volatility chart. A little bit, there's a bad piece of data here, a little bit back. So blue line is your, implied volatility, green line historic. Basically, the range in implied has been 30 to 40 over the last year. You got a spike back in March, up to 47. I didn't get a chance to go in and, find out why, but generally you're talking a 30 to 40 vol range. That to me is, a big part of, okay, how do things look? Where's my edge here? So I pulled up the July, these are next week expiration, and you can see the 48 strike is basically running about, 40%, 41% implied volatility. I think I just was able to pull up, here is this Friday's expiration, and you can see the IV here is wildly higher, in the 60s. Okay. So, obviously there's a lot more premium. And then, the last strike I pulled up was going out to August. And, that 48 strike is in the, the low 30 range. So, that's there, for me personally, I haven't traded Delta, what's the best width of time to sell and buy. Obviously it looks like with those short-term implieds, in the 60 range, that's your best edge. And then, buying, I chose the August 18th expiration because it's a monthly. So, if I had to go in here and put on a spread, I'd be selling this Friday, and I'd be, probably going out to August and doing the August, July weekly time spread in both the call and the put. But again, the key being, what strike. If I, wanted to, obviously sell a little less implied and a little less edge, I'd roll out to sell next July the 21st. But I will come back to this trade, on next week's call, and we can talk about, how Delta reacted to, the earnings that came out. But Russ, thanks for the questions.
This is
Sure.
Dave. Can I add a couple quick things? With the double calendars versus the calendars. I trade the calendars and double calendars a lot, and I can tell you some of the things to watch out for specifically. Like, okay, so the double calendar works kind of in reverse to like the iron butterfly. On butterfly, you can't lose on both sides, right? Well, the iron or the double calendar, you can't win on both sides either if you do the double calendar. You can only win on one side. So what you're hopeful, and by the way, the trade is best when you know how to manage it from the first expiration to the second expiration. Because the idea is for the double calendars, you want the stock to move exactly to one of your two strikes, and then you can decide to like just let the other side go away, or to turn it into a vertical spread afterwards. So the key to the double calendars is you want to know, it gives you options to manage the trade going forward. But you can't win on both sides. Like I said, you can only win on one side. So that's the one thing. And on single calendar, if you're bullish.
Hey, Dave?
Yeah, go ahead.
Just a question. I mean, why can't you win on both sides?
Well, let's say the stock is trading at, I had to detail an example. Say the stock is trading at 50, and you're gonna buy the 55 calendar on one side, and you're gonna buy the 45 put on the other side, right? That's you have two different strikes. So any calendar trade, the maximum gain situation is at the first expiration. If you are at your short strike, you are at maximum profitability, period, the end. And you can't be at maximum profitability for two different strikes. That's why you can't win. And you can win
Agreed.
maybe a little bit on both sides. You may win a little bit on both sides if that's what you're saying. I maybe not interpreted your question. But
no, I was basically looking at this as doing a put calendar and a call calendar, but in the same strike. I
don't know why you would do that. Why wouldn't you just pick one and do twice of it? I mean, anyway.
Well, you could, right?
Okay, so here's the other thing that I wanted to point out, though, and it is with your comment on implied volatility and how it affects delta. Is when you expect implied volatility to rise, that's when you use the calendar family. If you expect it to fall, that's when you use the iron condor kind of thing, where you expect implied volatility to fall as soon as you've sold it. It makes it whatever you sold worth less if volatility drops to the person that bought the other side of your trade. So you're using the calendar family when you're expecting implied volatility to rise at initial implementation, and then be higher than that at expiration. And since there's two expirations, you can kind of hope for it to be higher at the second expiration than the first one, and that would help out if you're right on direction. So there's I could talk a lot about calendars and direction, and I've done them a number of times, so I can at least tell you when they're going to be outcomes going to be the best and when it isn't. So calendars at the strike that you pick is where you want the price of the stock to be at the expiration on the calendars. That's the takeaway for calendars.
Agreed. Thank you.
All right. Well,
Any questions?
Discussion. I think we can always, come back to these type of strategies and discussions.
Josh?
Yeah.
When you're checking this, when you you do this manually versus automatically, as far as like the bull puts, it automatically chooses the strike prices. But with this, you have to go ahead and look at the expected move, or is the expected move already part of?
No, it's
the,
already, it's automatically done for the alerts. Like when the trade alerts come up, it'll be automatically lined up.
Because I didn't see that.
Yeah, they'll come out. Yeah, you can always check it, you know, I'll just verify it, but you know how to do that. Walking through it, but it should, you know, come out like 3-ish with the afternoon alert, and just make sure it's lined up, you know, properly. We can't, like that fast one could, you know, there's potential, you know, because we can't account for everything. You know, like, you know, it had 85, 48.5, and, you know, could be off balance. So you'd want to adjust that yourself. But for the most part, they come out, you know, how they should. With that earnings alert. And we can review that, yeah, next week when they come out, make sure they come out properly.
Okay, because I
But
didn't see. So you say it's gonna come out like at 3 o'clock or something, or?
Yeah,
with-
I think it's like 3:15 or something, somewhere in there.
Okay,
Yeah, for the afternoon trade. But, you know, in the meantime, you know, if you plan on doing that trade, you can kind of track it live too.
okay,
It doesn't take long to execute. I've done a bunch of them in the past. Okay,
yep,
okay. We can circle back next week and over time. So, you know, we'll do this meeting again next week, and, you know, thank you all for tuning in.
Thanks, everybody.
Thanks, guys.